In this video, I'm going to be going over adapting to the market when things change. As you can see, I've got this very detailed markup that I did a few days ago, and I actually had some limit orders set down in this area. However, I removed them last night before I went to bed. I'm now sleeping through the New York session and just trading Asia and London. But I took out my limit orders before going to bed because the market had changed since I had taken the screenshot. And then sure enough, today we are looking very bearish and we closed down all the way in this range. So just saved myself from taking um, a L by adapting to the market. So I'm going to talk through what I saw here and then go to the charts, look at what has actually happened, what changed and why I pivoted, and also look at what did exist, what opportunities were present, and what I'm expecting going forward. So it is currently Tuesday, November the 4th, after the close, and this is EST. So we've just closed the market, and so we're going to be opening up the Wednesday daily candle next. In the screenshot, you can see that this is gold. We had sold off. I actually had a limit order at 3885.6, which is less than 1 point below this previous week low. It missed it and rallied, so my limit order was designed to be hit as we hit this old previous week low. We never did, but I wasn't too worried about that afterwards because we started showing this really nice bullish order flow. We had a previous day low. We enticed longs, dropped down and then took it out only by a few ticks, but we did take it out and got a reaction off of it. I really liked this long wick because on the daily chart, this was a long daily wick that enticed longs. We then dropped back down, accumulated below that level, so accumulation, a long wick above, and any traders chasing the shorts, they see that long daily wick as a bearish rejection, and so they'll be putting their stops above it. We then run straight back up and we knock into that level. We're leaving heaps of smooth highs. And the narrative was that we had accumulated down here below these old previous state lows and trapped people short and then run back up and was expecting us to continue pushing. I really liked down here how we had this clear consolidation with the facts that we had manipulation closure below the this order block midpoint. We closed that candle below that line, the midpoint of this order block, and that indicates relative equal lows essentially. So relative equal lows above a order block in a previous area of accumulation. While we are technically really high time frame bullish, but yeah, so at this point it was looking really good for a long. And if we had dropped down right from here, like straight after, then that would have been a great place to go long. But as you'll see when I go over to the charts in a moment, you'll see that we actually continue to consolidate for a significant amount of time, and I'll mention why that was significant. This is the current chart. As you can see, markets close. We're looking incredibly bearish, closing right at the deepest part of this range after having this long wick, and it doesn't look like it's just going to rip straight up from here. I think it's very likely to take out these lows, which are basically relative equal lows. Below that, we have the low of week, and there is a reason why that could be a likely target. Although in this slide here, see this little diagram I've put up here, that would indicate that we would actually come to deep discount internal range and not take out external, which is a possibility. So I might look to get involved in this area. But the tricky part is that I wanted to buy below this low. So if I want to buy below that low and also up here and also up here, then I can't exactly have have my buy zone be from these relative equal lows all the way down to below the previous week low. That's a bit ridiculous. So I'll look for a bit of a reaction once we do hit these lows and potentially this low down here, and see if there is a opportunity to get long before the previous week lows hit. But in general, there is a reason why we could hit lower. You can see I've got this 4-hour low marked out. What we had reacted from is we had these relative equal lows. Below that on the hourly time frame, there was another impulse low. So we took both of those out really nicely.
can see it fell short of this new week opening gap, or not, or sorry, of the previous week low. But it did hit this new week opening gap down here, and as you can see, that's actually a breakaway gap. We opened up the new day. We did a tiny little work and then just ripped straight back up, and that is where we reacted from. The exact same thing happened on PLTR stock around the same time, and I missed that trade as well, where we had a breakaway gap. I think it was a Thursday, however, and I wanted to buy below that previous day low. The price came down to it, didn't take the previous day low, and just hit that breakaway new day opening gap and then ripped higher. So it's just an interesting dynamic, but essentially we had a significant wall of sell side and then continued to move around here. So it was looking bullish, but what stands out to me in here, so I'll get rid of all these drawings in a moment, but you can see this 4-hour low I have marked out, and that 4-hour low is essentially this impulse low, which is part of that original consolidation I mentioned over here. So that was my point of interest. Below that, we have a nice order block. So I had a limit order sitting at 3942. So just essentially right there, which I got rid of. Looking at the weekly chart, and I'll start explaining why it's not looking so bullish currently. You can see we've got this massive rally, obviously, and then following this rally, we created this down closing candle with a long wick. What happens immediately after? Well, we overlap that long wick, take it out. And the reason why is because classic trading patterns suggest that a long wick like that is a bullish rejection. So anyone who has been long throughout this entire run up, they don't want to lose their profits. They see the long wick, they think, oh great, the buyers are, holding price, they're rejecting price here. So they drag their stop loss up here, get taken out. Great reason why we could be accumulating those positions for another run up higher. But then we do the exact same thing here. We create another very, very long wick, and then we just start consolidating above it for a significant amount of time. To me, that's indicating that we're doing the exact same thing. Anyone who was taken out here, or anyone who doesn't want to have this pullback, they're going to think, okay, bullish rejection, move my stop there, and we consolidate a bunch of time and start rolling over. This is a concept I call the long wick plus no gap. It essentially indicates when we have a long wick and then we fail to make a displacement in that same direction afterwards, then it's likely to roll over and take out that wick, probably for accumulating or trapping traders. But in this case, we've got a long wick. We haven't started displacing higher, not even on the lower time frames. And I'm actually I've set it up so that I have an upside down chart. I just do a template and I have a regular template and a reverse one. And you can also do that just going here and doing invert scale. And I say that as a template so I can easily switch back and forward. But this is the upside down goals chart. And this is the regular gold chart. So just to get another perspective, you can see the same kind of thing. A massive pullback. Everyone needs a place to trail their stops. And we're printing these long wicks, and now we're rapidly overlapping it. We have these perfect vertical highs up here. There's also a flat candles, weekly candle up here. But just keeping that in mind. On the daily chart, there's that same area, leaving a lot of smooth highs up here, which is nice, and it also supports the idea that we may want to return back up here. And we are remaining below this old bullish, or this previous area of accumulation. We're remaining below that currently. This could potentially even be an intermediate term high. But I don't want to go too far into the bearish scenario because I am still very bullish. Like as I said, I may even buy down here. But this area right here is beginning to look a little bit more bearish. We have a lot of smooth lows here. Even all the way down here, we have smooth lows. And that's that flat candles weekly candle. My point of interest for buying initially was from 885, so below this previous week low, all the way down as basically as far as my personal capital would allow. I wanted to think of it as like a investment kind of thing, because
I don't think you can really go the past couple of years, you can't really go long buying a pullback on gold. So why would you not want to at least try this opportunity? And if you look over here as well, this is the monthly chart. Look how that previous month closed with a really, really long wick. Anyone who thinks that we're overextended, overbought, they're like, oh, sick, this is a massive rejection. The monthly is super bearish. This is a bearish rejection. I'm going to go short and put my stop right at the high, which just happens to be not quite at a very significant price target, which we are likely to hit. That being approximately that. So to me, it makes a lot of sense that we would be bullish. Previous month low is down here. That might actually be a better place to get in. And it's also getting on for 200 points below 4K. As I mentioned before on NASDAQ, when we have a level such as, let's say, in this case, 4,000, I like to see us reach above it, 100 and 200 points above, and the same to the downside, and kind of just sweep both sides. So sweep both sides kind of like that. So anyone who wants to buy in the breakout above or sell on the breakdown below, they then get their stops taken out before actually getting a push high. But gold tends to move a bit differently than NASDAQ. So NASDAQ, that's what I look for. And I mean, each indice, each asset has its own amounts. Like YM, I find is more like 400 points is better than 200. But that's not always the case. And if we look down at 3,000, which is down here, I believe, once we hit 3,000, which is right here for the first time, within the maximum we pulled back was actually only 50 points or so. So we only pulled down to the 50s from below 3,000. So it's only 50 points below, which we've already hit here, which is partly why I was wanting to accumulate on the low time frames in this area. But now I am pivoting. So I'm going to go now over the reason why I changed my thesis from buying over here to actually canceling my orders last night and saving myself a bunch of money by doing so. And that is a concept that I call it's a bull flag that I'm looking to fail. And also a delirium framework. A delirium framework is when you have relatively equal lows above an impulse low, and you kind of see that here, relatively equal lows, multiple, above a really obvious impulsive low. That is something that I look to fade. On top of that, we have the narrative of people trying to buy and to get and catch the low. And I saw a bunch of posts on social media about gold. Oh, that's a great place to buy gold. Okay, buy gold down here, buy gold here. And that kind of threw me off a bit. It was like, hang on, if everyone's thinking this, then it might not be quite what it seems. But then, most importantly, was actually the fact that we have a bit of a bull flag formation. Now, bull flags work if it's in a bullish market and we have already accumulated, recently accumulated sell side and in a discount. However, in this case, we have a really obvious low, relative equal lows as well, a really higher, and then we start consolidating sideways. This becomes a kind of a bull flag formation. And then you look, okay, well, let's say everyone who trades bull flags see this pattern and they want to buy up here. Where are they going to place their stop? Well, usually I look for a swing low. If there's a swing low in the middle of the range, let's say here, then we could come down, knock that out, and then continue higher. But when we have this situation, we don't have a single swing low on this 4-hour time frame where the bull flag is forming, other than external range liquidity. So that indicates that if we are to roll over, where is price likely to go? Well, it tends to attack swing lows. That is really what threw me off. And because at this point over here, like this is the Sunday Open, I believe. Yeah, that's the Sunday Open. So I did the analysis before the Sunday Open. And at this point, it looks like, okay, well, we could just drop down quickly on Monday
into this area and then rally from there. But when we start going sideways for multiple days longer, that's giving way too many people the opportunity to decide, you know what, I'm going to buy gold and put my stop down here. The more time that we spend above this area, the more liquidity is going to form below these lows, and the more opportunity there is for people to get in long. And this also begins to become that same concept I mentioned, the long wick plus no gap, where we have a displacement, basically a really obvious rejection. We even do have a long wick, and then we fail to displace. We just go sideways. So we've enticed longs, and then we're just going sideways, giving people the opportunity to buy down here. And then eventually that rolls over. You can see the same kind of thing, long wick, and then just overlapping it. Previous week low with a really long wick, so it does make a lot of sense for us to come all the way down here. Then if we look at the daily chart, I'll quickly go through the time frames and just note what stands out. But you can see we had a long wick to the upside. This is the one I mentioned that I wanted to see us stay above. And usually you'd want to see us stay above that midpoint right there. You can see that we knocked into it multiple times with wicks, and then eventually we've just overlapped it. But usually if we're bullish, you wouldn't want to see us like not even wick much past that midpoint. So the fact that we mixed past it multiple times was looking bearish. And another thing that really stood out to me last night when I did this, like I actually made the decision to cancel the order from my phone. But on top of what I just mentioned was also the fact that we were kind of showing bearish order flow. And what I mean by that is I was looking at signatures that I'd usually look for to indicate price was going lower. And one of those is that when we have an obvious liquidity pool that was clearly engineered for the purpose of accumulating, I look for us to reference back to that exact same pool. In this case, we have a sell-off. We have a very long wick right here that closes low. And then we immediately overlap it and take it out. So very obvious pool of liquidity that was engineered to entice people to move their stops there. We instantly run up and take it out right there and then sell off. What I want to see if I'm bearish is, do we reference back to that exact same pool and reject from it? And as you can see, if I put my cursor there, you can see that we actually came back to it a few days later perfectly on Monday, tapped it and rejected lower. And that was all the indication I needed, is that on top of everything else, it's just showing clear bearish order flow. The narrative is saying that we've been enticing longs and there's liquidity below these lows. And just the amount of time we spent up here was just looking like, okay, it's not so good anymore. So that's that Monday high, tapping that previously engineered buy side. So engineers buy side, entices shorts, runs the buy side, closes lower, and then comes up again and just taps it. And then we begin to just roll over, leaving a lot of smooth highs, however, showing that bearish order flow. Now, at this point, what I'm looking at is how we have that very, very obvious low with these relative equal lows above it. This, again, is that delirium framework. The same thing here, relative equal lows, impulse low below. So really, realistically, I'd expect us to actually take out that swing low. That would actually make a lot of sense. And then that previous month low that's down here as well. So yeah, just here, that's that previous month low. That would make a lot of sense if we have a obvious sell side pull that we've engineered and enticed longs on that weekly chart of that long wick. If we're going to take that out, it's not just going to go down there and reject most likely. It's likely going to go to one liquidity pool a little bit further. That's something I've noticed with price. That's actually what the delirium framework is that we have an obvious liquidity pool, such as these relative equal lows. Price doesn't just go to those, it goes to the next pool beyond it, which if it's an impulse low, that's why I have a delirium framework, just to expect this low to get hit. Because anyone who's long from these lows, they're going to have their stop a little bit further away, and that's that low right there. With this previous weekly low, you could probably do the same thing and look for that next swing point as a likely place for stops. So this also kind of makes sense because it's 200 points. This is the 800s down here. That is also 200 points below 4K. That would be a very significant pullback in my opinion. But the thing is, I don't really want to miss it. Like, I'm perfectly happy to, you know, put some risk on, and I'm completely happy with it if it does lose, but only if I have a very wide stop loss. Like, I don't want to buy here, get stopped out there, and then miss a massive move. I kind of see it as a investment swing opportunity to buy down here somewhere. But at this point, it does look like it may want that low. So I think if we do sell off, I am very interested in buying below this previous weekly low. Most likely, I'd be looking below 850 for an entry, and potentially down as low as 790-ish, and just have a stop as far as my capital allows. However, rather than entering on a limit entry, I'd rather watch the chart and wait for an opportune time to get in, because if we sell off, like, sure, we could gyrate a little bit, but we're likely to have a fairly fast move in this direction towards these lows. I'd rather enter on a wait for at least some form of confirmation of reversal, like let's say a 5 minute loses its downwards momentum. That could be an entry point, even if it's sold off further. I just enter with my wide stop loss, but wait for at least the momentum to stop first. That's likely the plan. Definitely want to see these lows get hit. But as I mentioned, like, the reason this could actually be if we go to the 1 hour chart, the reason why this is interesting to me is because we have from this high down to this low, there are no inefficiencies that we haven't balanced. You can see that we had, let's just say on whatever time frame there's an inefficiency right here. Well, we clearly balanced it multiple times. And once we've balanced it like this becomes an intermediate term high. So short-term high, intermediate term high that fills an imbalance and sells off. So this now should not get taken out if we are bearish. What happens? Well, it gets taken out. Do we go to the next level of liquidity or inefficiencies? No. So we broke an intermediate term high while failing to take out a buy side or hit next inefficiency. To me, that is an intermediate term high market structure shift to deep internal range liquidity. That's the framework. And what happens? Well, we roll over to deep internal range liquidity. However, by deep internal range liquidity, that means that it is deep. So very, very deep in the range, potentially coming all the way down to the previous week low, but failing to take it out. That is actually kind of my expectation of something that could happen. Like I said, it does kind of conflict with my other analysis or other confluences, such as that delirium framework and the fact that this is a long previous week low. But that is kind of an expectation that could happen, and that's why I am actually interested in buying down here. However, it would be on a challenge account, because, as I said, it's a little bit conflicting. But that technically would be a delirium as well. We've got an impulse low with relative equal lows above it. So that could actually be a good point to buy at 905-ish, with a stop at external range. Then if we do trade down to this previous week low, I wouldn't just be jumping in there or even just below. I'd be waiting for an obvious turn, which would likely be closer to 850, which is down here. So just keeping that in mind. But yeah, on a challenge account, I'll probably give it a stab from here, because if that was the case, and let's say I bought here with a stop at the previous week low, even if it got down here and just got a reaction back up before rolling over, you could probably get to break even. And if it does manage to continue, you could easily make pretty high R. So that is worth a go. But in general, yeah. What opportunities were present? Well, there are a whole bunch of stuff in here that is pretty cool and all, but what I want to do is actually mark up not mark up, but I want to go over just one particular opportunity that I saw, which was this up here. No, not this, sorry, this area. And I'm going to get rid of half these lines as well. So what is it about this? Well, at this point, I was still very bearish because we hadn't even met my obvious sell side pull that I was targeting. I wasn't trading this, but you can see that this is a bit of a bull flag formation. Now, there are a few confluences that made this very high probability for a short. First being that, well, obvious sell side that we fell short of, clearly coming back towards. We have a bull flag formation while bearish would take out this buy side, and we are rejecting from that high, so it's an impulse rejection. And I'll drop down to a 15-minute now, but the main things to note is that bull flag, sell side, we are bearish. We've already retraced from external range from breaking this low to internal, and now we haven't yet hit external. So we're expanding from internal range to external, meaning that we don't need to have some massive retracement before selling off. It can just continue rolling over. And then on the 4 hour over here, this is really where the magic is the fact this is a previous hourly candle high, 4 hour candle high, and this next 4 hour candle fails to take out that high. So if we move this over here, you can see that that is the 2 a.m. 4 hour candle high, with the 3 a.m. candle high there. And then the next 4 hour candle opens up at 6 a.m. We rally, we fail to take out the previous candle high, and then begin getting this aggressive move lower. That is a squeeze reversal. That's what I called it, SQRE. And what that indicates is that we are having an aggressive reversal that is designed as a squeeze on whoever's in the trade. So usually, so it can either be a short squeeze or a long squeeze. In this case, it's a long squeeze because we're squeezing out anyone who was trying to get long, buying this rally, bull flag, so an enticing rally, a bull flag, and people were trying to buy out here, and then it fails to take out the previous 4 hour candle high, and then just sells off. So that becomes a squeeze, and you can anticipate that will take out the obvious level of liquidity, which would just be the external range. So that gave a beautiful opportunity for a short in here, targeting that low at a minimum. I'll drop down to the 15 and see how that looks. You can really see the bull flag at the moment here. And what else do you notice? Well, there isn't a single swing low on the 15-minute time frame. This is clearly a 15 minutes looking bull flag, and there are no 15-minute swing lows. We have a nice big rally here, big up closing candle, and then it just goes sideways, makes a really obvious low, continues going sideways, and then fails on that 6 a.m. candle, fails to take out the previous 4 hour candle high, and then we just start dropping aggressively lower. We have this nice big rally, instantly drops back down, and that becomes the sell-off. Now this is also, just get rid of some of these lines. If I drag this line, so that's that previous 4 hour candle high. If I drag it over here, this is the buy side that we just rated. And what's interesting about this is that it's a clear impulse rejection. And what I mean by that is we hit the impulse high. So this is the impulse high, we hit it. We reject lower, and then we never managed to close back above that high. So that is the indication of this being an impulse rejection, is the fact that after taking it and closing above it and dropping back below, we then never managed to close back above it. That combined with the bull flag, you can then look for a the impulse low, and which I assume would actually just be this, because this is the swing low, the impulse low that made the high. So all over here, we've got impulse low. We drag that out. This is an impulse rejection. We hit the low, but then we're waiting for a closure below it. So we close below the low. We then close back above the low, and then close back below. So that would be an entry right there. With a stop up there. But also, I say close below the low because sometimes it could just wick slightly and then it gets a bit confusing. But I think in this instance, this would actually count as us breaking that low and rejecting from it. So that's a impulse rejection. And then you're looking for a failure. We fail to take out the high here, so that's fine. And then we close back below. So that right there, that indicates that we failed to reject from this impulse low because we started to reject from it, and then we got a closure back below, which indicates that that's a impulse rejection failure. So yeah, forget what I said about this over here, but because in this instance, this long work below actually did take out some significant sell side and did clearly reject. So that would be the entry right there, right at that blue line. On top of this, we've also got a long work plus no gap slash a low time frame bull flag. We have a long work which entices longs. Anyone who's long throughout this range has a stop down there. And then we fail to displace, we just go sideways. So anyone who's bullish, they put their stops below this low. And so the fact that we then drop down aggressively towards it, you can trust that it should overlap this wick. But yeah, just thought it was cool having a really obvious bull flag and all the narrative behind it's why it should fail. And then we get this beautiful drop lower. And the main one being that 4 hour squeeze reversal, which, as I mentioned, is simply when a candle opens up and fails to take out that previous candle's high or low, and then instantly sells off from there. And you can kind of see it over here, I think. Yeah, I mean, you can see it here as well. This is exactly the same. We have a 4 hour candle low. So this is the 2 a.m. So that's 2 a.m. right here. So 2 a.m. to 5 a.m. That is a 4 hour candle, and then 6 a.m. opens up as a new 4 hour candle right here. And it fails to take out the previous 4 hour candle low. It does just tap that 1 hour candle low, but fails to take out the previous 4 hour candle low. And then what does it do? It rips straight up to the most obvious buy up here. And that's another indication of this exact same pattern. But we're going to be opening here in about 4 minutes, so I'm going to jump off and just watch the open. But those are my thoughts on gold. I'll quickly show the rest of the time frames on the reverse as well. So there's that long wick. Looks like we would easily want to take that out. And then on the daily chart as well. And you can see on the monthly chart on the right as well, a really long wick. But if we were to take out that previous monthly low, that is all the way back here, which in this upside down chart is the previous monthly high. So that would be this candle there. And above that, more smooth highs. So I'm not saying it's going to go all the way up there. That's why I'm keen to get long, or in this instance short, sorry, but keen to get long on this chart, somewhere in that area. But this is looking very bullish on this reverse chart. At least to these lows and potentially going up to here, but I'm not going to force it. We could even have a squeeze reversal on the monthly chart. Let's say we fail to take out this monthly candle and then overlap this wick. But yeah, on the 4 hour, you can see that same kind of pattern where we have an impulse low on the 4 hour chart that we take out and then just sit below for a bunch of time, with this impulsive high that drops down. We've failed to continue pushing lower. Hits a buy sides, builds up here from anyone trying to catch this short down. And then we start aggressively moving back towards that high. Leaving heat to smooth lows is looking kind of like it wants to come back down to this area. And also, if you look at this, from this low up to where we're at, we've never pulled back to EQ of the range, indicating that we are currently in a premium. So from this high, we are at a premium. We're still referring back to this exact same high, which means that this is now at a discount on this reverse chart. That'll do for this video. It's good to get some thoughts out and just recalibrate my expectations on gold. And I'm just stoked that I was able to recognize that it was not like this buying opportunity was no longer what I thought it was, and mitigate that. And now I can reassess maybe we just rip up without taking these lows, but then that'd be something completely different. But at the moment, got my eyes on that swing low right there.